Hello everyone. Welcome back. Today, we've got some crucial news you don't want to miss. Let's dive right into the top financial headlines and break down what's happening. Here are two major developments worth keeping an eye on. 1. Bloomberg reports Eurozone inflation rises but won't derail rate cuts. Bloomberg recently reported that while inflation in the Eurozone has bounced back, it's unlikely to stop the European Central Bank, ECB, from moving forward with rate cuts. The concern started yesterday when Germany's inflation data shocked markets, coming in much higher than expected. This raised fears that if the Eurozone's overall inflation mirrored Germany's spike, the ECB might pause its easing policy, something that could rattle global markets. Fortunately, today's data from Eurostat brought some relief. Inflation in the Eurozone for December rose 2.4% compared to the same time last year, right in line with economists' expectations. For comparison, Germany's rate was slightly higher at 2.9%. This alignment with forecasts reassured investors, and Bloomberg concluded that the ECB's rate cut plans remain intact. That said, Bloomberg also pointed out that inflation in major economies like Germany, France, and Spain is still relatively high. Because of this, the next ECB rate cut is expected to be 25 basis points rather than 50. Interestingly, inflation across the Eurozone remains uneven. While some countries have rates above 2%, more than half of the member states sit below that threshold, hovering around 2%, a sweet spot for economic stability. Today's inflation report eased market concerns, showing that extreme scenarios haven't materialized. For now, the Eurozone seems to be avoiding any dramatic economic imbalances. 2. The Wall Street Journal, Fed official warns of overvalued U.S. stock market. In a rare move, a Federal Reserve official issued a stark warning about the U.S. stock market, saying valuations might be too high and vulnerable to a major correction. This warning, reported by the Wall Street Journal, has sparked plenty of debate. After all, it's not every day that the Fed openly comments on stock prices. Fed Governor Lisa Cook said on Monday that several asset classes, including stocks and corporate bonds, are significantly overvalued. She highlighted that risk premiums, basically the extra reward investors demand for taking risks, are at historic lows. According to Cook, this suggests that markets might be priced to perfection, leaving them susceptible to a sharp downturn if negative economic news or shifts in investor sentiment occur. While her comments sound dramatic, the market reaction was muted. The Wall Street Journal even mocked Cook's statement, comparing it to former Fed Chair Alan Greenspan's famous warning about irrational exuberance, which did rattle markets at the time. In contrast, Cook's remarks didn't seem to faze Wall Street much today. So, was Cook exaggerating? Maybe a little. While it's true that valuations in the S&P 500 are high, this is largely driven by the so-called Magnificent Seven tech giants, whose soaring valuations and rapid growth have pushed the index's average metrics higher. Tesla, for example, has a sky-high price-to-earnings (P/E) ratio of 160 to 170. But if you strip out these tech behemoths, the median valuation of the other companies in the index aligns closely with the past decade's averages. Of course, markets always carry risks, whether economic, political, or geopolitical. Cook's warning, while perhaps a bit alarmist, serves as a reminder for investors to stay vigilant and prepared for potential shifts in the market landscape. These two updates, on Eurozone inflation and the Fed's market warning, offer important insights into the global financial landscape. Whether you're tracking interest rate changes or stock market trends, it's clear that 2025 is off to an intriguing start. Next, South Korea's Yoon Suk-yeol finds unexpected allies among young conservatives. Let's dive into a big update reported by Reuters. The headline? South Korea's embattled leader Yoon finds allies among young conservative men. Over the past couple of weeks, the political climate in South Korea has been anything but calm. President Yoon Suk-yeol was facing intense nationwide criticism, almost like the entire country was ready to oust him. But here's the twist: things have started to shift over the last couple of days. The turning point? Young conservatives, who had been largely silent, are now stepping up and making their voices heard. And they're not doing it alone, they're rallying together, creating a noticeable counterforce to the wave of opposition. Reuters highlighted the story of Park Byung-hyun, a 25-year-old who became a standout figure at a recent pro-Yoon rally. Park delivered a fiery 10-minute speech in English aimed at foreign media, where he slammed attempts to arrest Yoon. His message was clear: this is our country, and we must protect it. He also shared a personal reflection from his interactions at rallies, saying, "The older generation often tells me, when we're gone, it's your future at stake. That's what's driven me to attend more rallies in the past few years." Traditionally, pro-Yoon rallies have been dominated by retirees, but the recent protests have seen a growing number of younger participants. This shift is significant, as it's starting to balance out the overwhelmingly negative sentiment that Yoon has faced recently. At the same time, public support for South Korea's opposition party has been slipping, according to recent polls. Adding fuel to the fire, allegations about opposition leader Lee Jae-myung's connections with North Korea have resurfaced, sparking fresh controversy and debate. The question now is, will this emerging support for Yoon Suk-yeol continue to grow and tip the scales further? While it's too soon to tell, one thing is clear: the political landscape in South Korea is no longer as one-sided as it was just a week ago. This development is definitely worth watching. The dynamics are shifting, and it's anyone's guess where things will go from here. Thirdly, let's focus on JPMorgan's big move, back to the office 5 days a week. Here's a major update from Bloomberg that's sparking debate across the US. JPMorgan Chase, one of Wall Street's giants, is now telling its employees to get back to the office 5 days a week. Why is this such a big deal? Let me break it down. During the 3 years of the pandemic, remote work became the norm for many white-collar workers in the US. Most companies adopted a hybrid work model, letting employees work from home for a good chunk of the week. Even after the pandemic ended, companies tried to bring people back to the office full-time, but employees weren't having it. Take Google, for example. Some of their top scientists flat out said, "If you make me come in every day, I'll quit." This pushback has kept most companies from forcing a full return to the pre-pandemic 5-day office grind. Now, here's where it gets interesting. Studies show that about 20% of remote work time in the US falls into something called ghost work. Basically, people leave their computers on to look like they're working, but they're actually doing other things. For employers, this means a big chunk of time is lost, and that's a tough pill to swallow. But here's the dilemma: if companies push too hard, employees might just walk out. This is why JPMorgan CEO, Jamie Dimon, making this bold move matters so much. JPMorgan is the first major Wall Street firm to enforce a strict 5-day office work week. The outcome of this decision could set the tone for the rest of the financial world, and beyond. Why? Well, if JPMorgan succeeds and employees comply, other companies, especially on Wall Street, are likely to follow. On the flip side, if employees push back and Dimon's plan fails, it'll send a strong message to other firms: don't even try it. For some context, Amazon tried something similar recently, but had to backtrack because of widespread resistance. Elon Musk, on the other hand, has been famously strict, insisting his teams work from the office full-time. Meanwhile, Goldman Sachs is also pushing for a 5-day workweek but has taken a less aggressive approach. Then there's Citigroup, which has taken a completely different stance. Known for its more relaxed culture, Citi lets most employees work in the office only 2 days a week, with some executives showing up 3 days. It's a stark contrast to JPMorgan's hardline approach. So, why does this matter beyond JPMorgan? Because it's about more than just one company or one industry. If Dimon's strategy works, it could ripple across not just Wall Street, but other industries and regions. Companies everywhere will be watching closely to see if employees will trade their cozy home offices for a full-time return to their desks. Long story short, JPMorgan's move might seem like an internal policy change, but it's shaping up to be a defining moment for workplace culture in the US. Stay tuned, this one's far from over. Finally, let's focus on Zuckerberg's big shift. Meta leans towards MAGA. Here's a story that's been making waves across US media today. The Wall Street Journal ran a headline that's turning heads: Meta ends fact-checking on Facebook, Instagram in free speech pitch. Let's break down what's happening here. Mark Zuckerberg, the CEO of Meta, Facebook's parent company, announced some major changes, signaling a dramatic pivot for the platform. In a video statement, Zuckerberg declared that Facebook is ending its fact-checking program. Yep, you heard that right. No more fact-checking. Now, if you've used Facebook, you've probably noticed its strict content moderation policies, which many felt leaned heavily left. Posts deemed too controversial or inaccurate often got flagged or taken down. But Zuckerberg's message is clear: those days are over. In his announcement, Zuckerberg said Meta is simplifying its policies to reduce errors and restore free speech on the platform. He openly admitted that Facebook's approach hadn't been as free as it should have been. Instead of fact-checking, the platform will implement something similar to Elon Musk's community notes on X, formerly Twitter. So, what sparked this shift? The Wall Street Journal ties it to Zuckerberg's growing relationship with Donald Trump and the Republican Party. Let's dive into the details. Just before Thanksgiving, Zuckerberg had dinner with Trump at Mar-a-Lago. Meta then donated $1 million to Trump's new foundation. The company recently hired Josh Bolten, a former aide to President George W. Bush, as its global policy chief. And yesterday, Zuckerberg announced 3 new Meta board members, including Dana White, president of the UFC and a staunch Trump ally. Here's where it gets interesting. After the announcement of White joining Meta's board, the company's stock jumped 3%. So, is Zuckerberg really aligning with Trump and MAGA? The Wall Street Journal thinks so, framing this as a full-on pivot to the right. But I'd argue there's more to it. If you look at Zuckerberg's history, he's never been one to stick to any particular ideology. For him, it's always about maximizing personal and corporate interests. Remember when he tried to cozy up to Xi Jinping, asking him to name his daughter? Or when he publicly ran in Tiananmen Square while China faced global criticism for its pollution? Zuckerberg's latest move seems less about embracing conservatism or MAGA values and more about hedging his bets with the incoming Trump administration. He's adapting to the political winds to keep Meta ahead. Whether this strategy pays off for Meta in the long run, or if it backfires, is something we'll have to watch. For now, it's clear that Zuckerberg isn't about values or ideology, he's all about the bottom line. That's all for today. Thanks so much for watching. If you found this video helpful, don't forget to hit the like button and subscribe for more updates. I look forward to seeing you in the next one.